Welcome to the AACFB's 2023 Meet the Funder webinar series. My name is Monica Harper. I'm the Executive Director of the AACFB, and I will be your host. Our presenter today is Dana Freeman with Maxim Commercial Capital. Maxim Commercial Capital is both a funding source member and a silver sponsor of the AACFB, and I'd like to thank them for their support of the association. Before I turn it over to Dana, I'd like to go over a few items to make this webinar more enjoyable and informative for everyone. During the presentation, you should see a Q&A box that allows you to ask questions. If you have any questions during the presentation, please submit your questions in the box and they should be answered by the end of the webinar. The entire webinar should take no more than 30 to 45 minutes. For those of you who'd like to review this webinar at a later date, it will be posted on the 2023 Meet the Funder page of the website, and it will be emailed to the AACFB membership. At this time, I'll turn over to Dana. It is all yours.
Hey, everyone. Thanks for attending. Just going to go through and try to keep it, relatively decent pace of kind of going through. I don't want to, bore you with granular details. So I'll go through kind of what we do here at Maxim and then open it up for Q&A. Some of our products right now are very timely due to market conditions, particularly the real estate, which I know for most of you, I'm guessing the majority of the people attending today are specialists in equipment finance. So later in the presentation, I'll get into our real estate products where we can either use real estate to help get equipment deals done, or we can use real estate to get working capital deals done. Some pretty creative solutions for situations that a lot of small business owners are in right now. So stay tuned for that. Maxim's been around. We're a sponsor and a member of AACFB. You'll see me at a lot of the conferences. If you saw me in Orlando, I was scooting around on a little electric scooter. I got kind of smashed up in a skateboard crash, but I'm better now, so all good. So anyway, we kind of get into Maxim here and have on our initial slide, show us the collateral for creative financing solutions, because Maxim has been known for being sort of the creative lender that uses collateral or relies on the collateral to get more challenging subprime credit deals done. So we'll get into some of our different programs here, kind of overview our solutions, the types of borrowers that would be a good fit, and whether it's coming from a vendor or a direct relationship you have with a business owner. We'll kind of go over our borrowers. Get into we have 4 primary programs. We'll get into each one of those. We have the owner-operator truck financing, heavy equipment, real estate, and our sort of unique structured financing program where we can use real estate or equipment or a combination of both real estate and equipment to get deals done. So we'll get into that. And then just how to get started with Maxim if you're not already onboarded with us, and my contact info, of course. So we're kind of known, I guess this isn't super original, because a lot of folks are in the more challenged credit say when the banks say no, we can help, and that's sort of what we do. We do it in a different way than some lenders because we can get creative using real estate in addition to doing the tougher deals, with heavy down payments. We can use real estate or other collateral, equipment collateral as well to get deals done in a creative way. So definitely we're one of those lenders where, if it doesn't fit the traditional sources, think of us, because we can get creative to get deals done. So you might want to use us, for instance, if someone's wanting to buy a used truck or, new equipment too. But a lot of times people are doing used equipment with us just because they're trying to find a deal on equipment. And, for our programs, a lot of times, we like the used stuff just because it's not taking that initial hit in the devaluation, whereas we're focusing on the value of the equipment, and that's how we kind of back into these deals. We look at the value of the equipment and figure out what the down payment could be based on the customer's credit, time in business, and the value of the equipment if we did have to take it back and resell it. So we kind of back into the deals looking at the collateral. Since we're a collateral-based lender, we look at that first and then kind of look at the customer and the business. So newer used equipment, that's one reason. Unlocking liquidity that's tied up in real estate, that's another reason. A lot of people might have business capital needs, but maybe their revenue is not sufficient to get a traditional working capital loan. So we can use someone's real estate Could be commercial real estate, could be even their primary residence, except in Texas. But in other states, we can use a primary residence as a way to get business working capital. And I can get into that program when we get to the real estate section. We do a lot of helping people get out of expensive short-term debt. So if you have a customer that's gotten sort of buried in some merchant cash advances, maybe they got stacked up with 3 or 4 positions and it's just killing their cash flow, we've got great solutions to help your customers get out of that situation and get back to being bankable again and getting better financing once they get those MCAs cleared up. So we got that coming up. So the types of customers would be owner-operator truckers, construction contractors. We can do some ag. It's not our specialty, but we do some farms. We have small, medium-sized business owners and the real estate owners and developers. So that's the types of folks that you'd be sending us either through vendor relationships or direct relationships with business owners. So again, the 4 main programs we have: owner-operator truck financing, heavy equipment, real estate, and structured. And we'll go into each one of those and I'll give you a little more detail. And then of course, in the Q&A, I'd be happy to go over any questions you have on any particular programs, or if you have a sort of a deal scenario you want to go over, we can go over those too. So just some highlights on the programs here. With owner-operator, that's something we're really known for. And if you've been working at all in owner-operator right now, you know that that industry has really tightened up from the bank perspective. A lot of lenders have either completely pulled out of the owner-operator market, or they're having larger fleet requirements and looking for a lot more stringent credit requirements to do those deals. So we're still a very good solution for the folks that are maybe leaving a carrier to start working on their own and want to get their first truck. There's not many lenders doing that, doing those startup owner-operators, and that's something Maxim will do, and we are very good at it. Now, of course, a startup owner-operator is a very risky deal, so there are going to be down payments on those deals. We can get as low as 25% on those startup owner-operators, but it can vary. It can be as high as 50% if their credit's weaker or the truck might be a little overpriced. So I'll get into that a little more deep in the section on trucking, but that is our trucking program. Heavy equipment, we do really unique programs where we can also use collateral to reduce or eliminate the down payment. The heavy equipment program, we have larger ceilings on how big a loan we can do. In trucking, we do have lower limits just due to the inherent risk in the owner-operator segment right now. For startups, we're funding up to $60K. For over 2 years' time in business, we're funding up to $74,000. So typically that will get someone into a good first truck that's maybe we kind of have a date range where we go back to 2017, but 2017 to maybe 2020, a nice used truck after the down payment, that funding amount is plenty to get them into a nice truck. So we'll get into more detail on that. Heavy equipment, we can go all the way up to 250,000. So a lot more leeway to do the larger equipment in heavy equipment deals. That would include vocational, like dump trucks, yellow iron, things like that. That's a great program. Real estate, we can go from 100,000 all the way up to 3 million. That program we'll get into more details, but that's a great one and very, very timely right now. A lot of people are looking for working capital options and might not qualify for revenue-based working capital. Real estate program through Maxim is an excellent solution for that. The structured program, again, a very unique program where we can do a blend of equipment and or real estate. So it can be just equipment that we pull capital out of for working capital, or we can use the combination of equipment and real estate. So that's a very unique program as well. So let's dive in a little deeper to each program. We'll start with the owner-operator trucking. We do probably the majority of what we do is this program. We really are well known for this. We do a high volume of this. Again, the deals are, relatively small, typically probably in the 20,000 to 70,000 range for most of these deals. And we can go as high as 80% of the cost of the truck we can finance. But lately, with the market being in a little bit of turmoil, freight recession, more challenging situation, we are probably starting realistically at about a 25% down payment versus a 20%. So not to say we couldn't get to 20 if the customer was a fairly strong credit for a startup, or, maybe they were 2 years time in business, but had some really redeeming qualities, we might be able to get 20%. But I would say you could count on sort of 25 up to 50. The tougher the client, the riskier the deal, the higher the down payment and the higher the rate. So our pricing and down payments is all risk-based. The riskier the deal, the more down and the higher the yields are going to be on the deal to compensate. So very simple, just sort of risk-based pricing. You bring us a decent client that fits our program and the truck is priced right, you have a very good likelihood of getting into a deal at 25% down. If it's a super risky one, it's going to be a higher down and potentially a higher rate as well. So we go back to 2017 on trucks. With tractor trailers, the Class 8 trucks, we do cap mileage at 700,000 miles. With the box trucks, it can go to 250,000. And on reefer trailers, we'd like the hours to be less than 15,000 hours on the reefer unit. Now, if you're bumping up against those mileage limits on the trucks, we will require a warranty, and that can add to the cost. So what I would recommend is trying to be, below the mileage limits by 100,000 if possible. So if you can find, 600,000 mile truck, or, maybe a little over 600 will be good, no warranty requirement. And same on the box truck. If it's 150, 170, we could probably get by with no warranty to make the deal more affordable for the client. Trailers, we can do dry vans and reefers. Again, 15,000 hours on the reefer, and we don't want to be right at like 14,900. We might be a little concerned that the reefer unit goes bad or something like that. So we do have kind of that concern if it's too close to our limits. But in general, those are sort of the limits we look for the equipment to be under. And with owner-operator trucking, some of the things I'd mentioned, customers for that program would be either maybe they have a low FICO or limited credit. We do get a lot of new owner-operators that are immigrants that haven't developed a lot of credit in the U.S. We are fine with immigrants that do not have citizenship, but they do have to have permanent residence. So that's one thing to keep in mind. We don't require citizenship, but they do have to have permanent residency. We can't work with just a work permit or asylum visa. They have to have some kind of residency that's permanent, and we could, we're good to go on that. Again, no citizenship required. Low FICO, if maybe they don't have tax returns, they're a startup, they have a past bankruptcy. We're fine with bankruptcies as long as they are discharged. So as long as it's not an open bankruptcy or a dismissed bankruptcy, it's not a problem for Maxim. We're good. Even if it's fairly recent, we're okay with a bankruptcy. If there's a past foreclosure, or if they're, a non-CDL investor, we're one of the few lenders that will do a non-CDL investor. Now, we do want it to be a legit non-CDL investor deal, not a straw purchase. So for instance, if it's like a doctor or an investor wanting to buy a truck and they have drivers they're going to put in it, we will do those deals. We do sometimes have to price at a premium because those are one of the riskier deals in our portfolio when we do a non-CDL investor, but we will do them, and we do a fair amount of those. Now, if it's just like a family member signing for someone that has horrible credit, that is not what we're looking to do. But if it is a true investor deal, we can certainly entertain those. The terms on these deals, like I said, we can go up to 74,000. We can go up to an 80% LTV. Most of the time, we're probably going to be closer to 75% LTV. We can go up to 60 months. And again, we can go up to 60, but most of these trucks we're getting with 500,000, 600,000 miles on them. We don't want to go out to 60 on those trucks with higher miles. If it's a truck with lower miles and the customer's fairly strong, we might be able to get it closer to 60. A lot of times these deals are going to be 36 or 48 months, just due to the fact that these trucks get 100,000+ miles a year. And if it already has 500,000 or 600,000, we don't want to extend the term too long and have the truck break down while the client is still trying to make payments to us. Because one thing is unique to owner operators versus the big fleets. With an owner operator, if the truck's not on the road, chances are they're going to struggle to make their payments. So we want to keep these guys on the road, keep them earning money and able to make their payments. So we try to do these deals in a way that's a win-win for both us and the customer. We really try and work with these guys to keep them on the road, keep their trucks in good condition. So we're not going to put them into some older truck with tons of miles and stretch the term out and have them, obligated for a long term and maybe end up with a broken down truck. So we try and take all that into account here at Maxim. And, I think you'll see if you do look us up on Google, if you're not already working with us, we do have excellent Google reviews because, we really try to work with our broker partners and our customers, that you refer us to keep sure, make sure those customers are earning money. That's what we want. We want to give them a chance to get a truck when someone else might have turned them down, give them that opportunity. But, for us and for them, it doesn't make sense if the truck's broken down and they can't drive it and they can't make their payments. So we try and take all that, more of a holistic approach to these challenge credit deals, making sure that the folks stay on the road and make a good living with their truck. So here's some example deals that we funded recently. We're seeing a lot of 2019s. You can see some nice ones here where the truck price was in that, nice sort of sweet spot for us. The 70, 80,000 is a great sweet spot. You can see with the down payments and then sort of what the broker commissions are on those types of deals. So, some really nice broker commissions, 6,600 on the first one there, 46 and 4,000. And the interesting thing on these types of deals is right now there are a lot of brokers that have gotten discouraged if they were really focused on trucking because it has gotten tougher. This has gotten tougher. During the pandemic, truck prices were going up. Everyone was lending on trucks. The drivers were making a fortune. Things have changed. Truck prices have come down. A lot of lenders have pulled out of the market. There are brokers that were focused on trucking that have diversified. They've gotten kind of frustrated. And while I wouldn't tell you, hey, go all in on trucking, just focus on that niche, I think it's a great niche to maybe add to your repertoire if you're not already doing trucking, because there are a lot of people struggling to get these trucking deals done now, particularly the owner-operator deals. So I would say keep it in mind because there is a need, there is a lot of demand, and there's not a lot of sources offering it. So if you can be unique and maybe help some of these folks get a deal done, it could just add to the current business you're doing that's maybe outside of the trucking industry. So anyway, that is the owner-operator trucking program. On to the heavy equipment. With heavy equipment, we do agricultural, construction, transportation, and vocational. Now, agricultural is not a specialty, but we do some deals from time to time if it makes sense. With agricultural, we're going to be focused more on the larger tractors that we can finance versus a lot of the small attachments and things. So we try and stay away from the attachments. Sort of a rule of thumb for Maxim is we like to have equipment that we can either, we always want to put a GPS on the equipment, but we like the equipment to have wheels or tracks. So if it's just an attachment that we can't put GPS on, it's not kind of a self-contained unit, that is something we try to avoid. Now, occasionally, if we're doing a tractor, maybe we would do an accessory with the tractor, but as the main piece of equipment, we try and avoid the attachments and accessories as the main piece that we'd be financing. So ag, we do a little bit, not our specialty. Construction, the yellow iron, we love that stuff. And I would say our strength in this heavy equipment program is using additional collateral to get deals done at very competitive terms. So with this program, we don't currently go as low on the down payment as the trucking program. The trucking program, which is sort of our claim to fame, that program, like I said, we can get down to 20 sometimes, but typically we start about 25%. With this program, we're kind of more in the 40 to 50%, unless there's additional collateral, but that's where we really shine. So if you have a customer that maybe owns a bulldozer or a few bulldozers and is looking to add another one to his fleet because he's getting more infrastructure projects, with all the new infrastructure spending, he wants to add one, but he has some free and clear ones. If the free and clear bulldozers are 2010 or newer, if they meet our guidelines for what we would fund, then we can use it as additional collateral, and we can actually either reduce or completely eliminate that, potential 40 to 50% down payment. We can get rid of it if we have enough collateral. And as I mentioned earlier, it does not have to be just, equipment collateral. It could be real estate collateral as well. Even a primary residence unless it's in Texas. There are homestead laws that prevent us from using primary residence in Texas. But this is something that this program, the heavy equipment program, can use either equipment collateral, or it can use real estate as collateral to get to a more competitive program, where the down payment is either very low or there's no down payment. We also have the transportation here, and that might be confusing because we do have the trucking program. The difference here is we can do the larger deals. So in trucking, like I had mentioned, we only go up to 74,000. That is our max. And that's after the down payment to the dealer. We could fund up to 74,000. This program is where we can handle those more expensive, newer trucks that might be 180,000. We can look at them here. Again, it would be potentially 40 or 50% down, unless they have other trucks that are paid off they could use, or real estate they could use. But that's something to keep in mind. If you have a challenge credit customer that has a large truck they're looking for and they want to use collateral, or they can put 40 or 50% down, that's where this program would come in handy. Then this is the side of the company where we do our vocational deals. So dump trucks, tow trucks, all your vocational trailers, like the heavy haul, the end dump, the belly dump, all that kind of stuff gets done through the heavy equipment program, whereas our transportation program just does the tractor trailers, the box trucks, the dry vans, and the reefers. So sort of two separate parts to the company, two separate underwriting departments, and slightly different program parameters in the way of the down payment and the payoff, but all under the Maxim umbrella, just slightly different. So I can fill you in on the details. Also, we can get you over the broker guidelines and go through the nuances of each program. But that is the heavy equipment program. And here are some of the borrower challenges, so similar to what we talked about in trucking, either turned down by banks, low FICO, tax return issues, maybe they're a startup. That's one thing I guess I'd like to highlight, is that Maxim is an expert at doing startup deals. A lot of times people might think of some other lenders that market their startup a lot more. We're kind of known for subprime, but we do actually a lot of good credit customers that just happen to be startups. So obviously, as you folks know, the risk is in the startup. So it's still considered a challenge credit deal, maybe not from the credit standpoint of personal credit. Maybe they're a good A credit personal credit, but their business credit is limited, no pay net. They're new in business, under 2 years. Those are the kind of customers we do a lot of those deals as well. So don't think, oh, they have to have a really bad FICO score for me to send it to Maxim. They could just be a startup, and our startup rates are very competitive with some of the folks out there that the names that are out there for doing startups. We're very competitive with those startup rates as well. It's just we're going to be a little bit more limited on the equipment we would accept. So Maxim is known, like I said, for wheels or tracks, sort of hard assets. We're an asset-based lender, so we're not going to be doing software or restaurant equipment for a startup. It's going to have to be heavy equipment or over-the-road trucks. So think of us for startups. Think of us for the challenge credit. We can sort of do it all here at Maxim. So keep us in mind for that. The terms on this, similar in the way of the term. A lot of times we want to keep it 36 or 48. We can stretch to 60 months on the heavy equipment, especially on the larger piece of equipment. We can go all the way up to 250 on heavy equipment versus the 74 in trucking. We are only up to 75,000. Once the deals get up, 100,000 plus, we do like to see a little bit of financial details on the client, maybe a PFS or some tax returns. We do have early payoffs available in either of our programs. They are slightly different, so I can kind of get into that if you have questions. But yeah, that's heavy equipment. Here's some recent deals that we've done in heavy equipment. We can do the skid steers. We can do lifts, dump trucks, tow trucks, these flatbed tow trucks. So all kinds of stuff there. You can see some commissions here, anywhere from 1,600 up to 5,900. That's some example deals for the heavy equipment program. Now over to real estate. Now we do list office, retail, industrial, multifamily, residential, and infill land. Now, currently, office, as most of you know, is a very challenging niche. Now, prices have gotten pretty competitive. A lot of office has come down. Depending on what a client's looking to do, we might be able to help them with office, but it's obviously a very sort of caution niche. So we try to be careful with office right now, just because, you know, some cities office values have dropped by 50%. So we do have to be very careful on office. But if someone owned an office building free and clear and the amount they wanted to borrow was reasonable, you know, we can always take a look. So I wouldn't say, you know, cancel office completely, but it's going to be a conservative area for us. Retail can be the same depending on the area. Retail is a little tricky, but you know, we're still doing some retail deals. I would say right now, multifamily, the residential, the industrial, that's probably where we're doing the majority of our real estate deals right now. Infill land, which would be like a lot within a developed area in a city or something, we can look at those, but land only deals have also gotten a little bit harder, just because depending on how active the market is, if the deal went bad, we could be sitting on that land for a long time. So we're going to be pretty cautious on the infill land deals, but again, we can still look at them. So with the real estate program, as I mentioned, we can go anywhere from 100,000 all the way up to 3 million. And we can get up to a 70% LTV or combined LTV. The combined LTV is if they have a first on it, we can come in a second position and loan them money. Now, right now, we probably are a bit more conservative and not stretching all the way up. So best case scenario, maybe we could get to the 70 if the planets align and the borrower is you know, fitting exactly what we're looking for, and the property's in a very liquid real estate market. There is a chance we could get to 70, but more realistically, I would say probably sort of 50 to 60% LTV or CLTV is what you could expect on these types of real estate deals. So if you get someone that has a property that's free and clear, they're looking for some working capital for their business, or they're wanting to pay off MCA or some other type of, you know, high interest, short-term debt that's just killing their cash flow, our program can be excellent for that. So if they have free and clear property, or they have a really low rate locked in on a small first, and they still have some good equity, so we can get in there in a second position. We don't have to refi that first. So sometimes our rate plus the competitive rate they have on that first, that blended rate can actually be very competitive compared to what some hard money lenders would do. They'd want to refi that whole deal, get a first position, but then they might take them to like a 10% rate, and they're losing out on that 3% first that they had. We won't require that. As long as there's enough equity, they can keep the first. We come in a second position, and the blended rate can be very competitive sometimes. So keep that in mind. Great way to get some working cap, even if it's just 100, 150,000. A lot of times it's going to be much, much more competitive than a traditional short-term working capital loan or a merchant cash advance. So real estate program is excellent for working capital if your client happens to have real estate with equity. Again, some of the reasons: borrower challenges, capital tied up in real estate, expensive short-term debt, they need some bridge capital. Typically, we do these deals on a 60-month fully amortized loan with monthly payments. But if the situation is, you know, really meets the circumstance, and everything is like, okay, this lines up right for it, we have done deals where we do interest only for 12 months with a balloon, or we do interest only, then convert to amortization. So we can get creative. So if you're looking for a situation that's more of a short-term bridge, we can look at deals like that. We just have to kind of do it on a case by case. But typically, we are just doing a 60-month fully amortized term loan on the real estate. So these are business loans. They're not mortgages. It's a business loan, just using the real estate as the collateral. Since we're a collateral-based lender, we always have to have some kind of collateral. And whether it's equipment or real estate, there's got to be something there. The terms, again, 60 months. Typically, we can do all the way up to third position, but realistically right now, we're probably mostly just doing first and second. All credit profiles, we can do early payoffs, interest only bridge loans. Yeah, so we can get into that more in the next program is the structured. I'll talk a little bit about that, and also how to send deals in, how to get onboarded if you're not already onboarded, because One thing I'll tell you about our structured program and this real estate program is now more than ever, people are, that own businesses, they're looking for creative ways to get working capital. And this is something that might be overlooked by a lot of brokers. You might be focused on revenue-based working capital, or, trying to get them, other solutions that just might not be a fit in this sort of tightening market. A lot of banks and other lenders are tightening up. So it's getting harder to get those unsecured working capital loans. So having something like this where we are using collateral, we can buy much deeper. We can work with those clients that maybe are having a little bit of pinch in the revenue, wouldn't qualify for revenue-based loan. Maybe they've gotten a ding on their credit recently that's hurting them. But anyway, keep us in mind for these programs, because we are unique in the way that we can help people through these creative products get that working capital they need to grow their business. Here's some example deals in the real estate program. And, again, getting rid of those MCAs can really, really make a difference for a business owner. I'm sure you've, run into them a lot of times. Not only do they kill the cash flow, but they also prevent some of these folks who have very, very good credit. It prevents them from getting loans through a lot of your traditional sources. I'm sure you've seen that, where you send a deal in, the banks have a working cap or a MCA on there, and the deal just gets squashed by the lender. They don't want to do an equipment loan on folks that already have these daily or weekly payments coming out of their bank account, because it kills their cash flow. So our program could be an excellent solution to get someone cleaned up, get them out of those short-term loans, and then make them back to being bankable or fundable through your A lenders that would not do a deal if the deal did have those daily or weekly withdrawals on the banks. So some example deals here, small ones for like 110, we can go all the way up to 2 million. We can go up to 3 million, but we're not normally doing, the $2 and $3 million deals. We do those from time to time, but I would say the sweet spot is a lot of these folks are needing anywhere from 100 to 500K. Those kind of deals all day long. We love them, especially, as long as the real estate's decent real estate and the market is liquid, where we're not going to be in a rural area. We try to stay away from rural and land deals, things that would be harder for us if the deal did go bad. So if it's a liquid market and the real estate is in decent shape, all day long, 100 to 500, that's sort of the sweet spot lately. We've been doing a lot of those deals. So here's some example deals. Getting into the structured. The structured is what I mentioned earlier, where we can use the either equipment, the real estate, or a combination of both. So keeping in mind, being able to pull cash out of equipment. Now that does have to be free and clear. We can't have any, second position on equipment. We can do it on real estate, but not on equipment. But one thing to keep in mind for Maxim is we will do equipment. It's not like a traditional sale leaseback where it's like, well, they had to have bought it 6 months ago or 8 months ago or a year ago. We'll do it. They could have bought it 5 years ago. As long as the equipment has value and it meets our guidelines, like it has to be equipment that we would finance. So if it meets our guidelines, like on yellow iron, it would have to be 2010 or newer. So if it's 2010 or newer and meets the guidelines of the hours or mileage, mileage would be on a truck. Trucks, it's not 2010 or newer unless it's a dump truck. But like if we're using tractor trailers, it has to meet our guidelines for tractor trailers. So it would have to be a 2017 or newer with less than 700,000 miles. So basically, if it meets our guidelines based on how we would finance equipment, we can use it as collateral. We can do cash out loans. Now, we are conservative on the LTV when we're doing cash out of equipment because cash out of equipment is riskier than financing the equipment. Because sometimes people are needing cash because they're struggling. Now we're going to look through the deal, make sure that they're not on the verge of going under. We don't want to do these deals to get the equipment or to get the real estate. We're trying to do these deals to help someone get into a better position, not put them into a worse position. So if it's just one of those things where, this person's on their, very last sort of ditch effort and it doesn't look good, we're not going to jam these people into a loan and neither you or Maxim wants to do that. We don't want to put someone in a worse position. But if we look over the deal and we see, okay, by leveraging their equipment and getting them that working capital, or leveraging the real estate and getting them that working capital, or paying off that short-term debt, or getting the money they need for this big project or this contract, we're putting them into a better position, giving them an opportunity to make more money and make their business better and grow. We're all for it. So that's what we look for here, is we're trying to help people and help them grow, not jam them up. So anyway, the structured program is unique in the way that we can use a combination. So sometimes you'll have someone that might have like a commercial building, a warehouse, and then they have some equipment that they store in there, like bulldozers, excavators. If they were trying to use just the equipment to get the loan, maybe they couldn't quite get to where they want. But by taking that real estate and adding that component to the collateral pool, they can have a larger collateral pool that gets us to the limit for us to get our LTV and get a loan that really does make a difference and is enough to help them. So keep that in mind. That's the essence of the structured program, is using equipment, real estate, or a combination of both to get folks that working capital. So again, the borrower's challenges are kind of uniform across our programs for the most part, except for, with the real estate or the structured, it's helping them get out of debt a lot of times. That's one of the things. It's working capital sometimes, where they just need working capital and they don't qualify for revenue-based working capital. But a lot of times, a surprising amount of times, folks get buried in those merchant cash advance. I get it. It's easy. It's fast. You get a call and boom, you can have the money in your account the next day. It's seductive. Hey, that's super easy. But then you do it a few times and your cash flow is just destroyed and you're trying to find a way out. But as I mentioned earlier, many lenders won't touch you once you have those withdrawals because your cash flow is destroyed. So that is probably one of the biggest things we do, is help people get out of those, and hopefully they don't make the same mistake again and get back into them. But great solution for that. So I would say that is what I would really, really keep this product in mind for, because as we get into these sort of tumultuous economic times, fourth quarter, maybe first quarter next year, we're seeing a little more turmoil in the economy. And I think you're going to see a lot more people that are in a bind with these short-term loans that are looking for solutions to get out of those. So the first question should always be, do you have any real estate? And again, it can be both personal or commercial. It doesn't have to just be commercial, and it can be their primary residence, or it can be rental properties they have. So it does not have to be tied to their business. It just has to be something we can use for collateral. So keep that in mind. Terms on these, with this program, since it's structured, we do have the lower, when we're doing real estate only, it's 100K up to 3 million. On this, we say 20K to 3 million. The 20K piece is more if they're using equipment as the collateral. If they're just doing an equipment collateral deal to get that money, get that working cap, we can go down to 20K. We can go up to 250, but that's with equipment only. On a real estate, we do kind of want that to be 100K minimum, just because the titling and everything involved in a real estate deal is much more complicated. So we don't want to be going through all that effort for a 20K deal. So 100K on real estate only. If it's a structured deal that's using equipment for collateral, we can go all the way down to the 20K. And we're going to be typically basing it on the auction values or forced liquidation values. So, if someone's like, oh, I got this dump truck's worth 80,000. I want to borrow 80,000. Doesn't quite work that way. We're going to be looking at what are these things selling for at the auction, and then we're going to be doing a percentage of that. Just in case the deal goes bad, we don't want to be upside down in it. But if they have a large enough collateral pool, we can get them some pretty good money. So keep that in mind. The terms on these can go all the way up to 60 months. And then I haven't talked about broker points, but on most of our deals, most of the equipment deals, we pay 8 to 10 points. So some really good money in the deals. On real estate only, if it's just a real estate deal, we can go up to 5 points. We tend to back it down. If it's a deal in the millions, we'll back it down to, maybe 1 or 2 points, maybe 3 points. But on a smaller deal, $300,000-$400,000 deal, we can go up to 5 points to the broker. On the structured deals, if we're using equipment as the collateral for a working capital loan, we can get up into that sort of 8 to 10 range. And then if it's kind of combo of equipment and real estate, we can also get up into that higher point range. If it's just real estate, we try to keep the points a little bit lower, sort of in that maxing out at 5, like I mentioned. So anyway, that is the structured program. Here's some example deals where we're using either equipment or real estate. You can see these are, second lien deals on some of these, using equipment or a combination of equipment and real estate. So again, you don't have to read through all these in detail. I can give you more detail. We can get you a copy of the presentation if you like, or you can always call and we can go over any deal scenarios or any questions you have. And I'd love to get you on board with Maxim. So as far as that goes, getting started, if you're not already onboarded, we do have the broker app and agreement available on our website for download on the brokers page. Our website is just maximcc.com, or you can shoot me an email. It's just a matter of getting the broker app and agreement filled out, sent in. Normally takes a day or two to get you set up in our systems. We are happy to onboard all brokers. We will work with brand new brokers. There's a lot of lenders out there right now that have very stringent requirements and require you to be a broker with 5 years in business, and they want 200,000 or 300,000, a month or a quarter or whatever. We do not have those. We realize we're an auxiliary lender. We're going to be helping you get those occasional tougher deals done that are not a fit. We want to be in your waterfall, so if it doesn't fit your traditional lenders, think of us. As long as it is something with wheels or tracks or a real estate deal that fits, we'd love to be there, help you get some of those deals done and impress your vendor partners, your end user partners, help you get more business, make that extra money that maybe has been deals that were getting thrown away or set aside because you felt like, wow, I don't have a source for this. My other source declined it. Think of Maxim. Let us help you get those deals done. Here's my contact info. And again, be happy to talk with you, preview deals, anything you need. Feel free to reach out by email or give me a call. Thanks.
Thank you. We do have a few questions, and for anybody who is wanting to put in a question, go ahead and type those in now, and we'll get those answered. First question is, will this presentation be emailed with your contact information? So obviously your contact information is right there. We are recording this presentation and we will put it up on our YouTube channel. It'll also be up on the AACFB 2023 Meet the Funder page on the website. So we can definitely get you a copy of this presentation.
Yeah, I'll make sure you have a copy too, Monica, so you can send it directly, or I'd be happy to get it to anyone. I also will be getting a list from Monica of everyone that attended, and I'll send out an email either tomorrow or Friday with a link to the download.
Great. Question, can you lend on a portfolio properties sale? It would include approximately 7 SFR in one transaction.
Possibly, yeah. We do large collateral pools like that. We do have a minimum value where every property in the portfolio would have to be worth at least 200,000. So sometimes we do see those where it's like a bunch of small, $75,000 or $80,000 houses. We can't do that. But if everything in the portfolio is larger, 200, 250K, we could certainly take a look at that and figure it out. A lot of it depends on how leveraged it is. If they have loans on all of them and they're pretty leveraged, then it might be tough. But if they're free and clear, or they have very small firsts and there's a lot of equity, then certainly that could be a perfect fit.
Right. Bill Hubbard has said he's used you in the past, wants to know if he's still a partner. So I will let you look at that.
Yeah, definitely. Yeah, you're on board and ready to go.
Great. What are some of the rates to refi residential property?
Well, we don't really do like refis. We're not a mortgage lender. We're using real estate as the collateral for a working capital loan. So if they have a first on there that's competitive, we would typically just want to do a second position lien and lend that way. Our programs are more of a working capital loan. So the rates are going to be between 16 and 24%. So they're very competitive if you're comparing it to working capital loans. But if you're comparing it to mortgages, it would be not what you'd want to offer your client, because our term only goes to 60 months and the rates are considerably higher, even though mortgage rates are up to 8% now, you know, a hard money lender that would just refi and maybe get you into 10 or 12%, if they're really wanting to refi, then maybe a hard money lender or a traditional mortgage lender would be a better fit. If they're looking to pull out some equity for a working capital loan for their business and they have a lot of equity and a low rate on the first that they don't want to refi, then that's when Maxim really makes sense.
Great. Not seeing any more questions. So we will go ahead and wrap it up. And obviously, if anybody has any questions later, please reach out to Dana. I'm sure he'll be happy to get back.
Definitely. Yeah. Anyone, again, thanks for your attendance. If you do have questions or deals to preview, feel free to call me. You got that's my direct line right there. You won't have to deal with voice prompts or anything. That gets right to my desk. So I'd be happy to go over deals with you or get you over the onboarding pack or broker guidelines with all the rates. Anything you need, just hit me up. I'll be here. Thanks.
Awesome. I want to say a big thanks to all our participants, and especially our valued funding source member and silver sponsor, Maxim Commercial Capital. Thanks for a great job, Dana. We invite everyone to meet with Maxim in person at our 2024 AACFB annual conference coming up in Phoenix, Arizona next April. Thanks again and have a great day.
Thanks, everyone. Take care.